Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. We spend a lot of our time together talking about the equity side of the deal, owning the property, forcing appreciation, and building tangible wealth. It's what we know, it's our home turf. But there's another side to every single transaction, the debt side, the mortgage, the loan, the paper. Today, we're taking a step back from the world of brick and mortar to explore a fascinating parallel universe for real estate investors. It's a world that operates on the exact same principles we use every day, but with a completely different type of asset. We're talking about high-yield bonds. I know what you're thinking. Martin, this is a real estate podcast. Why are we talking about the stock market? Because my point of view is this. If you understand how to analyze a value-add Class C apartment complex, you already have all the fundamental skills to understand high-yield bonds. You just don't know it yet. Today, we're not just learning something new, we're discovering how your existing expertise gives you a massive advantage in a totally different arena. We're connecting the dots. Let's get into it. First, let's demystify the terminology. The term high-yield bond has a less flattering nickname you've probably heard, junk bond. Let's be clear, that name is mostly just marketing. A high-yield bond is simply a loan made to a company with a lower credit rating. Think of the real estate you know. You have your gleaming Class A apartment building in a prime downtown location. It's brand new, fully leased to top-tier tenants, and incredibly safe. That's an investment-grade bond. They are issued by bulletproof, blue-chip companies with stellar credit ratings. Think of them as your AAA corporate tenants. The rent is reliable, but because the risk is so low, the returns are modest. Now, picture that 1980s vintage Class C apartment building in a transitioning neighborhood. It's got good bones, but it needs a new roof, the kitchens are dated, and the management is a little sleepy. That's a high-yield bond. The tenant, the company that issued the bond, is seen as riskier. Maybe they have more debt on their books, operate in a more competitive industry, or are in a turnaround situation. Because of that higher perceived risk, they have to pay a much higher rent in the form of interest to attract investors like you and me. To get specific, credit rating agencies like S&P and Moody's grade bonds on a scale. Anything rated BBB- or higher is considered safe investment grade territory. Anything rated BB+ or lower falls into the high yield category. It's not an insult or a moral judgment. It's simply a risk classification, the same way we classify properties as A, B, or C. This is the core concept, the mental model I want you to build. A high-yield bond operates on the exact same principles as a value-add real estate deal. Let's break it down. The tenant is the company. When you buy a bond, you are the lender. You are the bank. The company that issued that bond is now your tenant. Their financial health is their credit score. So your first job, just like in real estate, is to underwrite your tenant. You analyze their financials. Do they have a solid business? Do they generate enough cash to pay their bills? Are they likely to pay their rent on time? It's the same discipline. The rent check is the coupon. The fixed interest payment you receive from the bond, called a coupon, is your monthly rent check. With high-yield bonds, this check is significantly fatter to compensate you for the risk. As of right now, in late 2025, the average yield on high-yield bonds is hovering in the 6.5% to 7.5% range. Now stop and think, how does that compare to the cap rates for B or C class properties in your target market? In many cases, it's very competitive, and it comes with zero toilets to fix. Vacancy risk is default risk. The number one risk for a landlord is that your tenant stops paying and you have to evict. That's your vacancy risk. In the bond world, this is called default risk, the risk that the company can't pay back its debt. This is the primary risk you are being paid a premium to take. Forced appreciation is credit improvement. This is my favorite part of the analogy. In real estate, we buy a C-class property and force appreciation by renovating it, improving management, and raising rents. In the bond world, if the company you loaned money to gets its act together, improves its financial health, pays down debt, grows its earnings, its credit rating can get upgraded. When a bond gets upgraded from BB to BBB, it's no longer junk. It's now a safer investment-grade asset. That makes your bond much more valuable to other investors, and its price will go up. You've just forced appreciation on a piece of paper. Just like with real estate, you make money from a bond in two primary ways. Understanding this dual return structure is critical to seeing the full potential. Engine 1, yield, the cash flow. This is your bread and butter. It's the high coupon payment, that fat rent check that shows up in your account. For many, this steady, predictable income stream is the main attraction. It's the cash flow that defines the asset. Engine 2, price appreciation, the capital gain. This is the profit you make when you sell. A bond's price can increase for two main reasons, and they should sound very familiar. First, interest rates fall. If the overall interest rates in the economy go down, your bond, which pays a higher fixed rate, suddenly becomes much more attractive. Investors will pay you a premium to buy it from you. Its price goes up. Second, credit quality improves. As we just discussed, if your tenant, the company, gets healthier and gets a credit upgrade, your bond becomes less risky and more valuable. You can sell it for a capital gain. This dual return model, generating income while waiting for appreciation, is the exact wealth building engine we strive to create with our property portfolios. It's the invest and expand phases of our prime framework, just applied to a different asset class. Let's bring this all home. High-yield bonds are not some scary, abstract instrument from a Wall Street movie. They are driven by the same fundamental logic you use every day as a real estate investor. You find an undervalued asset, you perform deep due diligence on your tenant, you collect the attractive cash flow, and you look for opportunities to add value or benefit from market improvements. The risk is tangible, just like in real estate, but it's a risk you are explicitly paid to take. My point of view is that understanding this parallel makes you a more sophisticated and well-rounded investor, period. It opens your eyes to new ways to generate income, to diversify your portfolio, and to understand the broader economy. Your challenge today, this is a simple but powerful first step. I want you to go to any major financial website, Yahoo Finance, Bloomberg, whatever you like, and look up the ticker symbol HYG. It's one of the largest and most popular high-yield bond ETFs. You don't need to analyze it or buy it. I just want you to find one number, the yield. See what that number is. Now, open a new tab and look up the average cap rate for a B or C class multifamily property in your city. Put those two numbers side by side. That comparison, that simple data point, will be incredibly eye-opening and will set the stage perfectly for our next episode. Next week, in part 2, we're getting tactical. We'll break down how an individual investor can actually buy into this asset class, the due diligence you need to perform, and most importantly, what the chatter in the bond market is telling us about the health of the real estate market right now. You won't want to miss it. Thanks for joining me on this deep dive. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one smart move at a time.